How's everyone feeling this afternoon? Yes. Thrilled to be with Chris Vermeulen and my new friend, David Rosenberg. He loves the Habs, so he's good in my books. What's more important is, how are we feeling about what's going on in this metals run? We're going to try and get to the bottom of it and figure out what comes next. Chris, I'll start with you because I interviewed you recently. I believe you had called a $5,100 gold. That was on your radar. You were bearish, I think, short-term gold, but long-term bullish.
Yeah.
Where do we go from here?
Yeah, so when you and I talked, I said 51, 5,200 is a technical level where gold is going to run into some resistance. We actually liquidated a bunch of gold position today.
Oh.
We'll get into silver later, but gold it's just hit a level. We're at a point now where once you break 51, 5,200 in gold, we could pop into this euphoric phase. It could go a whole lot higher. Where's the top? Kind of bubble-ish phase, right? And so we just have to ride this out. Let's see where it goes.
I feel you have a top in mind.
I don't know. Could be 6,000. It could top out today. We just have to wait and see, follow price. The key is to follow price, not predict. Just follow the trend. You're never going to get out of the top. We have to let it eventually roll over, give back some of those gains, and then I don't like to hold things going down, so I naturally liquidate a position once a trend has come to an end.
When you say you liquidated positions today, how much are we talking here?
Like, it was about 5% of our portfolio.
Okay.
Yeah, just
Okay.
small.
Okay. David, thoughts on this run up in gold? And then we'll talk silver.
Well, I had long, like back when gold was $2,000 an ounce, whenever that was, like a century ago, it seems like it. I was saying that we were going to have, based on the work that we did, a $6,000 peak for a variety of reasons. I did say that once we got to 4,500, we were going to start to take some of our exposure down, which we've done, both in gold and the miners. I say that I am expecting there to be a correction in gold near term. I think even more so in silver, because nothing in this life moves vertical without there being a very big pullback, significant. I think that if you're going to try and play this, you'd almost want to have a spread between the mining stocks. You can go long the miners, and you can short the underlying commodity and probably make a lot of money because the mining stocks won't go down by as much. I think your previous guest said that, I don't know, he was talking about the juniors, but the Canadian gold mining stocks are indeed priced for 3,500 on gold, and silver miners are, say, priced for something more like 70. But they'll both go down together in a correction, just that the underlying price will go down by more. And then, if you have liquidity on hand, you'll be able to get back in to the trade that we all love at much better levels. I think in our interview I was talking about, I was born into the industry on October 19th, 1987. That was my first day as the financial economist at the Bank of Nova Scotia. My hair wasn't silver back then, but I remember that the market was down peak to trough the summer and fall of 1987 by 30%. And it was a very steep and ugly correction, especially on Black Monday. And a lot of people thought that the bull market was over, but it wasn't. It ended 3 years later. That said, does anybody in the room really want to stand in the way of a 30% correction just because you're at a secular bull market? I would choose not to. So I think that the secular story is still intact. All the stuff that's correlated with gold and even with silver, although silver's got its own unusual dynamics, everything is intact except that the prices have really deviated from all the moving averages. It's extremely overbought right now. So on a near-term basis, it could be 1 month, 2 months, 3 months. I would expect that the prices are going to go down and go down by a lot, and more silver than gold. And then if you have the belief, which I do, that the world isn't changing, Donald Trump's behavior is not changing, The global central banks that have been the primary driver of demand for gold, that's not changing. We'll just get back in. So I'd say, in this business, I've been doing this 40 years, everything is dictated, whether it's real estate, commodities, equities. We can't help it. We're not robots. AI hasn't changed our emotions, and the two primal emotions of fear and greed haven't gone away. So I would say that right now, and it's not just in the gold and silver market, but the greed has sort of gotten a little ahead of itself near term.
What do you think about that strategy, Chris? It's interesting what David's raising, short the commodity but long the stocks.
I've never been a fan of hedging. Hedging usually costs money. I like to be in something going up. If it's not, I'll find a different asset class to go in. So just hedging is another level of, if anybody's an active trader, then once you get into hedging and a little more complex, it's easy to have human error. And so I just would rather step aside. I believe we're going to see, once gold does peak, I think we're going to see a 30 to 40% pullback in gold. I think we're going to see a 40 to 60% pullback in silver. The monthly chart of silver, you zoom out, go back to the 70s. It is a scary looking chart. Easy come, easy go, straight up, straight down.
So I understand this argument. Let me take the flip side. For silver, if we want to use the word, it's gone parabolic. But anyone who's been in the gold market would be like, this has been a long time coming. It does not feel parabolic.
You're looking at me. Well, I would say that, it's the old saying in the land of the blind, the one-eyed man is king. So, I guess I would actually reclassify it and say that gold is definitely parabolic and silver is asymptotic. Mm-hmm. So, if you look at gold relative to silver, it's less crazy. But, when my quotes price objective gets met like 2 to 3 years ahead of schedule, I don't have any reason to raise my price objective. Nothing has really changed. It's just the price has changed. And I think the price and gold, and I'm much more bullish on gold than I am on silver for a variety of reasons. Silver's got this nasty historical tendency to get caught up in major supply squeezes. And just remember that in 1980, the Hunt brothers were cornering the market for silver, not gold. But both charts look extreme, and just silver looks more extreme. And I agree with everything that Chris has said. I think that we just want to all be reasonable people and check our greed in the lockbox. Gordon Gekko said greed is good, except at the peaks. Now, this is not the fundamental peak. I'm not sure if silver 115, which we had, I think, sometime this morning, was the peak. Gold, I don't think, has hit its fundamental peak yet. But you got to think that, if Chris is right and we're down, say, in gold even 20 to 30%, you don't want to participate in that, right? You want to avoid it because in any bear market, not a bear market, let's just say any correction, do you want to spend the next 12 to 18 months crawling back out of that hole? So I'd say nobody ever got hurt taking profits. And I think that now is the time. I think it's just become very extreme.
So let me ask you this then. For someone who's taking profits and doesn't want to be in cash, doesn't want to be in the dollar, where should they be parking it?
Well, I would say a couple of things about that. So I think we could look at gold and silver. Silver's got industrial capacities more than gold, but let's just say that they're both sort of like currency. They're used as currency. I think that for anybody who is spiritual or biblical, we'll go back to the Old Testament and you'll see that gold is mentioned 400 times. And I think silver is mentioned like 300 times. So they're like a form of currency. So I would move immediately, I'd say starting today, into the Japanese yen. Right now. Because I like to find things that are stupid cheap, that are under-owned. and that nobody even knows what the hell is going on. But what's happening, we are on the precipice of seeing a coordinated round of foreign exchange intervention between the United States and between Japan. Every single valuation metric says the yen should be 120 to 130. It just almost hit 160 today. I think right now it's 154. And I would just go naked long the yen. Just buy the yen. Call your broker, buy the yen. You can buy a yen ETF. I would not be buying the equities. I would not be buying JGBs. And you could make 20 to 30% just being long this one currency, which is the cheapest currency on the planet. And I'm also considering opening up a position in the Australian dollar. And I'll tell you why. Because the Australian dollar is a torque on Asia, which is the primary growth region of the globe. But more than that, investors globally are going to be looking for currencies that represent hard assets in a financially engineered world. And the Australian dollar is behaving very well right now. By the way, unlike the Bank of Canada, which probably is still going to cut interest rates, the Reserve Bank of Australia probably within the next 2 months is going to start raising interest rates because their economy is red hot. But Canada is going to be penalized by the fact that we can't help it. We are connected to the United States. What Mark Carney wants to do in terms of developing new trade relationships, that'll take decades before it really bears any fruit, if it does at all. We're sort of stuck. We're stuck with all the trade uncertainty with Donald Trump. And I don't even expect, once he's gone in 2028, assuming he doesn't find a way to serve a third term, I hate to say it, the Canadian dollar is just going to be stuck in the mud. Stuck in the mud.
Okay.
The question is, what do you want to be in? Japanese yen, Australian dollar, and that's what I would do with those proceeds from gold and silver.
Oh, you beat me because I was going to say Canadian dollar, but you answered that. Chris, what are you doing with cash?
Yeah, I think a currency play is a good play. I actually like, as long as the U.S. dollar finds a base here, if the economy does start to weaken, we tend to see the U.S. dollar strengthen. I think there's about 15 to 17% upside or so. So as a Canadian, I think holding U.S. dollars could become a very good play. Equities go down, we see the stock or precious metals eventually correct. I think the dollar could rally, but some other currencies might have more potential. But sometimes cash is a great position. A lot of people don't see it as a position, and when you have cash, you do need to park it in a currency, as David said. So I think you need to make sure you're holding the right currency, and sometimes you just need to sit on the sidelines in cash and just play that play. It is a play. A lot of people don't see it as a play, but it is.
Well, they don't like being in it because they feel like their purchasing power is diminishing. And
Right.
Right.
But sometimes there's no way to avoid losses. You just have to go where there's the least amount of loss. Inflation and currency is sometimes a great way to do that.
I want to get to this point, David. I know I brought it up in our interview of your global view of, bird's eye view of the S&P. You gave us a great breakdown. Chris, I'd like to know your thoughts too. If we do see correction, crash in the S&P, what that would mean for mining equities. Do they follow suit?
Well, you could argue that silver is connected to the AI bubble. And I hope I didn't offend anybody when I said it's a bubble, but it is a bubble. Silver's connected, copper's connected, the energy grid is connected, utilities are connected. This is what makes this different than what happened in the late 1990s when it was just tech and telecom. I mean, now when you're taking a look at all the different sectors of the S&P 500, except for healthcare, REITs, and consumer staples, all the other 8 gig sectors have an incredibly high correlation to the AI trade. It's all connected. The arteries are all connected except for those 3 sectors. You want to hide REITs, healthcare, staples. They're not connected to that trade. Now, I'm always told that, valuations only matter when they matter. But here's the problem for everybody in the room, is that when they matter, your head's sliced off. And then I'm told that, you can't use valuations as a timing tool. But who gives a damn about timing the market? Who the hell can time the market effectively? So I borrow a little something from Baron Nathan de Rothschild, who was the smartest of the Rothschild sons, who famously said that he got wealthy not by buying at the lows or selling at the highs, but playing the middle 60% of every bull market. Well, I would say that we are in extra innings on the S&P 500 as an asset class. And here's what really unnerves me is the relative valuations. Because when you're taking a look at the truest multiple on a long duration asset called the S&P 500, the CAPE or the Shiller multiple. Who knows what I'm talking when I say the CAPE or the Shiller multiple? Anybody? Okay, we'll have a game of bridge after the presentation. So it is a 10-year smooth that goes back to the 1800s. You can go Google it. The Shiller PE, the CAPE. And right now it's pressing against 40, not 14, 40, which means that the earnings yield in the S&P 500 is the grand total of 2.5%. But the 30-year TIPS yield, the real yield at the long end of the Treasury curve, matching duration asset to duration asset, is 2.65%. The bond market, the long end is yielding more in real terms than the stock market, and that hardly ever happens. It's a negative equity risk premium. So the markets are telling everybody in this room and everybody around the globe that the S&P 500 miraculously has become a riskless asset class. That stocks in this new era are less risky than government bonds, which to me is absolutely incredulous. So it doesn't mean that there's not areas to invest in. Slices of the market. I mentioned 3 of them, by the way, that are defensive and will not get crushed once the AI trade rolls over, which I think is in the process thereof.
Chris,
I'll leave it there.
Chris, you're nodding. You foresee a imminent?
Yeah, I think we're going to see a very big correction in the equities market. I think the Magnificent Seven as a whole, if you look at the basket of them, they were putting in a topping phase. I think we're going to see them pull back 20, 30% very easily like the tariff crash. And that could tip the scales for a bigger, broader market sell-off. And I think money coming out of equities could push into precious metals temporarily, push gold and silver for this final euphoric push higher. But there's going to be a huge correction, I think, in equities.
Let me get this question in before we wrap. I know we focus so much on gold and silver, but do you like anything else? Copper, uranium, platinum, palladium? Are you looking at any of these right now?
Platinum looks good. It broke out, had a nice pattern, but overall, I think the precious metal space is kind of done. We are positioned for it. We're actually starting to move out of it. I like the dollar. I like to move to cash, protect my capital. We all have big gains, most of us, in the precious metal space, and you do have to protect it. And as David said, why ride something down?
Yeah.
If you can follow price and it starts to crash, why would you ride it lower?
You two are the most cautious I've found in this in this room, and I think it's good to have perspective and different, voices of reason. So I thank that. I guess bring it home, David. Final thoughts.
Well, those are the operative 2 words that Chris said. This is, I think, what everybody should go home with.
Yeah.
These 2 words, capital preservation. Capital preservation, and I would also say the preservation of cash flow. So one of the reasons why I mentioned the REITs, cash flow, and they're trading very cheaply in a world of excessive valuations almost everywhere.
David Rosenberg, Chris Vermeulen, it's been a pleasure. Thank you. 20 minutes
Thank
flew
you.
by.
I know.
I loved it. Thank you.
That was just the intro.
Thank you, everyone.